But what if I told you that all this chaos, all this craziness we're seeing doesn't actually prove him wrong? Welcome to Wealthy Lead. So let's talk about Warren Buffett. In a 2025 market that's just buzzing with AI, crypto, and meme stocks, his classic advice about value and patience can feel, well, a little ancient, right? But is it? Or is it maybe more relevant than it's ever been? Let's get into it. Okay, just look at this contrast. It's pretty wild. On one side, you have the market we live in every single day. You've got meme stocks just exploding 500% because of a tweet, crypto tokens that pop into existence and then vanish, and just this constant, non-stop hype. And on the other side, you've got Buffett's entire world summed up in 3 words: patience, value, discipline. Honestly, it feels like we're talking about 2 completely different planets. And that really brings us to the big question, the one I'm sure is on your mind. Is all this talk about fundamentals and thinking long term just, outdated boomer advice? Is it something that just can't possibly keep up with how fast the world moves today? It's a totally fair question. But what if I told you that all this chaos, all this craziness we're seeing doesn't actually prove him wrong? In fact, what if it's the ultimate proof that he's right? We're about to peel back this illusion of his obsolete wisdom and show you why today's insane volatility might just be the best argument for his principles. Now look, I get it. The argument against Buffett, it sounds really convincing on the surface. He built his entire fortune on companies with tangible assets, brands you could literally see and touch. So the critics say, hey, those rules are useless now, when a company's value is all tied up in things you can't see, like data and network effects. It really can feel like you have to just throw the old playbook out the window. But here's the thing. This is exactly where that illusion just completely falls apart. I mean, think about the recent crashes we've seen in all those speculative assets. They proved one thing, loud and clear. Financial gravity is still very, very real. What goes flying up without any real value underneath it? Well, it has to come back down eventually. The wisdom isn't obsolete. We just have to learn how to translate it for this new digital world. And that brings us perfectly to one of Buffett's most famous ideas, the economic moat. So let's take a look at how we can spot these protective fortresses in a world that is almost purely digital. First, just a super quick refresher for anybody who's new to this. An economic moat is really simple. It's just a durable competitive advantage. It's something that protects a company from its rivals, kind of like the moat around a castle. Back in the day, this was a massive brand like Coca-Cola or a huge physical asset like a railroad. But here in 2025, the whole game has changed. That moat, it's very rarely about physical stuff anymore. The new moat, the modern moat, is built from these invisible but incredibly powerful forces. Things like massive amounts of data, network effects where more users makes the service better, and especially super high switching costs that create this powerful digital lock-in. So what does that actually look like? Well, think about a huge global company that runs its entire business on a platform like Salesforce. The cost, the disruption, the sheer risk of trying to switch to something else is astronomical. That, right there, is a modern moat. Or picture a company that has a unique proprietary AI dataset that nobody else can get or replicate. What Buffett would be hunting for today are these digital toll booths, companies that have found a way to own a piece of the road that is just incredibly hard for any competitor to get around. All right, this next principle. This might just be the most important one of all. And honestly, it's the hardest to master in 2025. This isn't really about spreadsheets or financial analysis. It's all about winning the mental game. It's you versus the market's hype machine. We've all heard this quote a million times, right? Be fearful when others are greedy, and greedy when others are fearful. It's the ultimate mantra for having emotional control. It sounds so simple, but actually putting it into practice in today's world, whoa, that is harder than it has ever been. And why is it so hard? Because your biggest enemy today is literally the algorithm living in your pocket. Social media is precision engineered to amplify emotional responses, and there is no emotion more powerful for an investor than FOMO, that fear of missing out. When your entire feed is just people bragging about their 10x returns, staying rational feels almost impossible. So here's something practical, a framework you can use to fight back. Let's call it the 48-hour rule. The very next time you feel that itch, that powerful urge to jump on a stock that's skyrocketing, just stop. Force yourself to take a 48-hour cooling off period. During that time, you have one job. Write down the real, fundamental business reasons why that asset is a great buy. And here's the moment of truth. If the only reason you can come up with is, well, the price is going up or everybody else is buying it, you've just saved yourself from walking right into a classic FOMO trap. Okay, let's pivot a little bit and talk about the bigger picture, the macroeconomic environment. Because with higher interest rates and inflation that just seems to stick around, Buffett's principles become even more crucial, especially his laser focus on a company's real intrinsic value. This table really lays it all out. In a world where interest rates are high, money is expensive, and that absolutely crushes those high-growth, no-profit companies that are constantly needing to borrow just to survive. All their promises of huge future profits get heavily discounted and become worth way less today. But on the flip side, companies with real pricing power, the ones that can raise their prices without losing all their customers, they can actually thrive. They don't need to borrow as much, and they're built to weather this kind of inflationary storm. And finally, let's talk about the bedrock principles, the ones that are probably the most counterintuitive in our hyper-fast world, the almost unfair advantages of patience and simplicity. Buffett has this famous saying, never invest in a business you cannot understand. This is what he calls his circle of competence. Now, in a world filled with black box algorithms and incredibly complex financial products, this simple piece of advice is pure gold. Why? Because complexity is often just a place for risk to hide. If you can't explain to someone in simple terms how a business actually makes money, you probably shouldn't own it. Period. And that really brings us to the real secret, the key to the whole thing. Buffett's incredible wealth wasn't built on a handful of genius stock picks. No way. It was built on the slow, quiet, but absolutely unstoppable power of compounding. That little snowball rolling downhill, getting bigger and bigger. And this requires the one thing that most modern investors just don't have: patience. Every time we jump out of a solid investment to chase the next hot thing, we're interrupting that compounding process. Patience isn't just sitting around. It's the active ingredient that allows wealth to truly grow. So, I'll leave you with this question to think about. The tools have gotten faster, the data is instantaneous, and the speed of the market has definitely changed, no doubt about it. But have the fundamental principles of building real, sustainable wealth, things like understanding value, staying disciplined, and being patient, have those really changed at all? Make sure you're subscribed to Wealthy Lead for more insights like this. Thanks for tuning in.